Torsten, who I really respect, talked about the other markets for supplying credit, but a lot of small firms and businesses don't have access to
less searching, more living. Ready to find
a small business in hiring and employment, I think, pretty substantially.
Given that credit interruption, do you agree with Diane Swank and Matt Lozzetti earlier, who said that they think that the bar is higher to cut rates than to raise rates again after a pause?
Well, let me think through that. I think that inflation's just too damn high. It's not 3 point something, it's in the fours. Whatever progress appeared to be evident in the data in the winter has now, if at best, stalled. And so, yes, I think this is a committee that is going to be very reluctant to ease until it really does start to see inflation moving down sustainably. And so I would agree with that.
So right now, as we look at this statement and we understand what you're saying, what more do they have to see in the banking sector in order to say, okay, hold up, this is something really serious that needs a little bit more scrutiny?
Well, I guess I guess it's an evolving situation. We've resolved two significant banks, resolved in the sense that they collapsed and they had to be acquired, facilitated by the FDIC. Look, let me say what I do believe. The banking system as a whole in the U.S. has enough capital, has enough liquidity, and is profitable. So this is not an issue about the banking system per se, but clearly there are fragilities among certain banks, in particular in that category between 100 to 250 billion, and we may not have seen the last of that.
If you are just tuning in live on TV and radio, this is a special edition of Bloomberg Surveillance covering the Federal Reserve decision from about 20 minutes ago. They hiked interest rates 25 basis points. If you're interested in the language shift in the statement that we got from last time they said the committee anticipates that some additional policy firming may be appropriate. A couple of lines have changed around that. The line now reads, in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over the time, the committee will take into account the cumulative tightening of monetary policy. Off the back of this, your equity market positive on the S&P by 0.4%. That's on the S&P 500. In the bond market, yields a bit lower at the front end. Not a big move. That move phased just a little bit. We're down about 3-4 basis points on a 2-year, 3.92. Just to look at foreign exchange briefly, the euro stronger, dollar weaker off the back of all of this, 110.65. The news conference, you're laughing, aren't you?
Yes,
€10 dollar, you love that.
Yeah, it's great.
11 minutes away from that news conference. It doesn't seem to change, Rich. I keep saying the same thing. Rich, I just want to jump in on the banking stress. Your former colleague, John Williams of the New York Fed, has really played down the role the Fed has played in this by hiking interest rates from 0 to 5 so quickly in a little more than a year. I'm just wondering what your assessment of that is, the contribution of Fed policy over the last 12 months to what we've seen play out at the regional banking level.
Good question. I have enormous regard and worked closely with John for nearly 4 years. I think as a Fed official, he is careful in how he chooses his word. I'll just tell you what I think. I think in every rate hike cycle, banks that have exposure to interest-sensitive assets are going to face challenges. You know, in the case of First Republic, they held a lot of mortgages. Mortgages get hurt when rates go up. In the case of SVB, they held a lot of securities, and so I think banks do maturity transformation. They borrow short and lend long, and when bond yields go up a lot, some banks are going to be challenged, and so I just think it's an inevitable part of monetary policy. As I said, the banking system as a whole is sound, but banks that have big exposure to rising rates that they didn't hedge are not surprisingly going to get hurt.
And I can ask you this because you're the monetary guy. If you're the regulation guy, I couldn't ask you this, Dr. Clare, but for you it works, and with your experience and your public service to the country, it's real simple. Everybody's scared stiff. LIBOR's back to where it is. This new SOFR's back to where it is. Kathy Jones over at Schwab is just out with where the FDTR rate is. It's back to where it was, which is 2006. Michael Spence was eloquent in 2010 about the regulatory failures leading into 07, 08, 09. Are we there again?
Tom, I don't think we're there. I don't believe we're there. What I will say is that, and I think the report that we got out of the Fed and and the GAO. I certainly read both of them carefully, and clearly there were things that were missed, not so much in regulation, but perhaps in supervision. And I do think that we will see that changed pretty quickly, and certainly I think that would be a good idea.
Rich, you know the Federal Reserve in your time there has been heavily criticised over the last few months regarding this issue. Can you share some of your experience in your time? Did these issues ever come up at board meetings that you attended around the names that have failed over the last 2 months? Were these flagged in any way, shape or form at the board level in DC?
Well, let me just say this. I was surprised by both of these based upon my entire experience, and in particular, what I would say is there was a focus. It was in statute in 2018 that the Fed should tailor to the.
Welcome in, everybody. Welcome in. So as we're waiting that to start, take a second for me to get into my pull my charts up just so we have this up for a point of reference. As Bitcoin right now, 28,586. I think there's a lot of uncertainty going on because the markets were preparing, which I've tried to allude to the fact it was impossible for them to pause already. So the markets are in no man's land. It doesn't know what to do. A lot of people were anticipating it to pause, but as we can see, it didn't pause. They actually raised rates by 25 basis points. Bitcoin's at 28,000, roughly 600 right now, 28,620. We've got XRP about the 4, 5, 6, 7 level, but that's neither near nor there. So I'm just going to do the intro real quick, and then eventually this is going to start with Powell speaking, and then we'll be able to get into this deeper. So good early afternoon. It's 2:24 p.m. Eastern Standard Time on this Wednesday, May 3rd, 2023. I'm XRP Future Millionaire, and I reside in the great state of Michigan. So once again, we can see the tomfoolery that takes place in crypto. We don't know what to think right now. The indicators right now, if we're looking at it, can we pull a nice reversal here? It remains to be seen. Right now, we're on the verge of committing a death cross here in the 30-minute time frame, but now we've had a volatile little exchange back and forth here. The 4-hour time frame, if it pulls down any farther, it very well could pull down into the bearish cross terms for the Dow Jones. So that's something else we need to pay attention to, because I was thinking it would at least come down into that range, or I pulled that down if we were to break down. So the reason I show this is because the stock market's going to have a direct correlation with crypto right now with what's going on. So I pulled that up on the side. If we want to take Bitcoin and see what Bitcoin's doing, it's below that 28,800. And furthermore, there's a 28,657 resistance there that it's been hit and beaten down by as well. So we'll see if we can get back over that. If it can, it would break over this little channel. But we've already been rejected in Unity right now. So we'll see what happens here. Because if we get a rejection here, this could signal move down to first 27,550. Then ultimately 25,194, which doesn't make us bearish. But it would definitely get us back on the right track if we dump down for some liquidity. But we'll see what the market makers have in store for us right now, as it's a very dangerous time to be in the market. So we'll see what happens here. If you're watching, make sure you hit that like button, as it can greatly help push me through the analytics and get more people in here. XRP Rippers member for 12 months. Respect, man. I really appreciate that. Darren, welcome in. Let me pull up my my YouTube on my phone just in case there's any issues with the YouTube stuff, as there usually is. Because at least then I can see everybody's comment. Okay, so Darren, welcome in. I appreciate it. Soti, welcome. Or Sati. Showstopper finally caught a live. Man, I appreciate that, Showstopper. Sheena, welcome in, love. First time catching the live. Thanks for the order. I appreciate that. Yeah, I wanted to do the live because we've got the Fed meeting in 3 minutes. If you guys are just tuning in, Randy, welcome in. Guys and gals, if you're just tuning in, make sure to hit that like button. Share this so we can get more people in here. But if not, whatever, that's cool. Honestly, I don't give a fuck whether or not you share. Whoever wants to be here is going to be here. Whoever doesn't just misses out. Honestly, it doesn't really bother me. But we had a 25 basis point rate hike. They were expecting a 50 or a pause. Everybody was expecting a pause. The markets anticipated that. But now A lot of people said, oh, we're pumping right after because we're going to get a pause. Now it's, do we get a dump at 25 or do we get a continuation on 25? If we would have got 50, I firmly believe it would have went down. Daniel, welcome in. I appreciate that. Not a whole lot. My water heater got, or my water tank got fixed, was covered under my appliance plan. So they had to put like a new igniter on there and whatnot. So the joys of buying a new house last year, I had to put a new HVAC system in this year, and then water tank's repaired now. So we'll see what happens. But yeah, so we got 2 minutes left until the rate hike. XRP, if we're looking at this on the chart, looking really bearish right now. I've talked about the inverted head and shoulder in the short term that came down, but we could technically still have one in the longer time frames, but it's looking very bearish. We've had the golden crosses here and all time frames leading up to the 4 hour, but now the 3 hour, 4 hour is pulling back down. And now we're looking to see if the 100 will finish coming through the 200 as it looks like it is. I expect a further move down with XRP unless we just get some crazy volume that pushes in. I expect XRP to have to retest this descending triangle breakout point at that 424 level approximately. But you never know. You never know. If we would have got a pause, it would have pumped. We would have already started pumping immediately. Now the market just doesn't know what to do. It doesn't know if it should start pumping or if it needs to dump if Powell's going to be hawkish. I've seen a lot of the rumors going around that they're going to stop raising rates after this month, and now, you know, that's why the markets are getting ready to pump. That's not true. They're not pausing. They said they could consider if they can make a discernment of what their actually rate hikes plan is. That just means that they are questioning whether or not they have to go through full throttle with the rate hikes or if they can go to zero, but they're not talking about reversing it. The quantitative tightening still stands as is. So we'll see, but it's going to start in like 1 minute. I'm going to put it on my tablet. Let's see. I'm going to put, what I'm going to end up doing is I'm going to put the US dollar up on the side. And then, actually, no, you know what I'm going to do? I'm going to have to, because I'll put this down like this because we'll be able to see this and then I'll be able to fluctuate. So that's what I like to do so that we can see the charts and see that. I like to like put it side by side. But I'm going to turn this up because Jerome's going to start talking. Oh, look at that. Right on cue. See what this scumbag has to say today. Oh, here we go.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor.
Oh, yeah, it's sound and resilient. First line of bullshit took them 30 seconds. We've had, what, 5 major banks collapse already? But sounds secure.
Conditions in the sector. We're committed to learning the right lessons from this episode and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Hey, Randy, what's going on? And Daniel, thank you very much. Welcome in, everybody.
Today, the FOMC raised its policy interest rate by a 0.25 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations
Hey, thanks for the kind words, Frenchie. No problem. No place I'd rather be.
appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal fund.
That's horseshit. If they were really concerned about lowering it to 2%, would they have bailed out the banks? No. Because when you print money, inevitably interest is, you're going to have to raise interest rates even higher to get that back. So they're full of shit. They continue to print money when they need to tighten it.
Rate by a quarter percentage point, bringing the target range to 5 to 5.25%. And we're continuing to
what the fuck
process
happened?
of significantly reducing our security.
Jerome must have said his first thing they don't like because the Dow just reversed like 150 points and crypto went down 300. So let's see what happens here. He better shut up, otherwise he's going to keep tanking.
Holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment.
Welcome in, Curtis, and yes, Daniel, what a lie indeed. And Darren, yeah, they never send the notification out, so I'm not surprised when I go live.
It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth.
See if he says something that interests the market, because right now the market's not very happy, and he's on the cliff right now. He better shut up.
And some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Swiss francs.
Thank you. I look forward to your questions.
What a scumbag this guy is. But XRP Rippers, thanks for the $20 in CHF. Is that Swiss francs? I feel like I'm getting more used to this, and if that's the case, sir, I appreciate you sending in that, because it's doing very well against the dollar today, so I do appreciate that. And Darren, a member of Tom's Army for 17 months. Holy shit balls. Thank you so much.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could...
All right, let's get ready for softball university here with the questions.
Tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points.
Yeah, 3 of the 4 largest banks did fail in the last 2 months. Cloaked. It's actually been 5, but 3 of the 4 largest in the history of the United States. Let's not forget.
On a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change, that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is, so let me start by saying that that's not my own most likely case.
Yeah, Timmy from South Park, that's perfect on the mound. And Darren, thank you for the 2222 and what was that, euros? I'm assuming that was euros. Good number indeed. I appreciate that, my friend. I do. I greatly appreciate that. Let's see what the markets do right now, because it doesn't, the markets don't know what they want to do. They're just in between here. They're just in between. Bitcoin's 100 points down from where it started when he started talking. And the Dow's basically, I don't know, it's having a little bit of a push here. So maybe, we'll see what happens here. We'll see what happens here. Let's see what else this numbnut has to say.
Which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people on the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's.
I'd be a little nervous if I was in the market right now, because every time we watch this, if it dumps while he's talking initially, it pumps. But if it holds on or pumps during his talk, it always dumps after. And right now it's holding on or pumped a little bit while he's been talking in the markets. But now they came right back down. So we'll see. If it can't get any steam here, the market isn't too excited here. So we're going to have to get a little bit of support here for this to start taking off. We'll see what happens here. Never say never, because it's very manipulated. And Tether just printed, as Darren knows. I don't even know how much it was. Let me look it up again.
Forecast for this meeting, we'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effect.
So 60 million in USDT, 52 million in USDT transfer from Tether Treasury to Kraken. So we'll see what happens with that. Darren, thank you for sending me that.
Of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type?
54 people watching, 34 likes. Hit that like button. That's the minimum I ask if you're watching.
Situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important.
I wish somebody would ask him a real damn question. Like, so Jerome, we've had 3 of the largest bank failures in U.S. history. What exactly about this banking sector is strong? Not only that, First Republic was basically seized by the federal government, and you allowed JP Morgan to buy them out and take over their clientele. What about this doesn't sound like collusion, and how exactly does this sound like strength in numbers here? To me, it sounds like you're eating alive the smaller banks and shitting them out to JP Morgan. That seems logical to me. XRP Rippers, thanks for the 20, I believe it's Swiss francs. I really appreciate that. I appreciate that. I need to read out what you said. Hold on.
This be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills.
Shut up, Jerome. We'll listen to you in a second, you son of a bitch. Thanks, Lotus. Yes, hit that like button. It really does help. Conrad, welcome in. I appreciate that. Yeah, I do the live streams because I want to try to keep everybody on the same page. But I'm thinking about doing a 30 or something like a 20-minute live stream every single day at noon or 1 o'clock to do sometime in the early afternoon. It's like a live update. I don't care if there's one person in there, but I'll do it for 20 minutes, do my market recap. And then if anybody's in there, they can ask me questions as I'm doing a live update. So that's something that I'm considering switching my style a little bit. Normal update in the morning, a session like that in the early afternoon, and then evening update is normal.
Long time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bill.
Oh, and XRP Ripper said with the 20 Swiss francs, thanks, Darren. Much respect to you, too. Always on the right side with you and Tom. Hey, I appreciate that, my friend. And I know Darren does, too. He's a good guy.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Exactly, Daniel. They spotted $50 million to JP Morgan for the buy. That's why I said when everybody said, why are you doing all your stuff through JP Morgan? Because I know JP Morgan's going to be around. It's that simple. I've done it for years. With my stuff that had to do with anything I have to keep in the bank, you have to. You have to. It's just the way it goes. And I don't like to keep a lot in the bank, but I mean, you got to have more than your local credit union when it comes to this. It's all horse shit. And then, yeah, Sheena, I definitely could see the 28,700, but I believe we hit 28,700 as he was talking. Let me take a look while we're listening.
Oh, thank you. Yeah. Steve Leachman, CNBC. Can you tell us what the
No, I guess we didn't.
in the
What time is it? 2:48.
Presentation where you were informed that Silicon Valley Bank.
See, it came up to 28,794 right after they announced the rate hike. And then all of a sudden it immediately reversed. And now we've got this bearish candle. But we'll see how it finishes out. There's still 11 minutes left. But we definitely got rejected at the 200 in the short time frame. But good observation because it definitely hit that level. It could possibly hit that again for a double top up there if it's going to get rejected. There's a ton of it in that area. 28,007 to 28. That's the reason why that's such a valuable area, Sheena. And here, we'll listen to this while I go to that.
And other banks were experiencing interest rate risks. And can you tell me what supervisory actions you've done in the wake of the recent bank failure?
God, shut up. So we've got this channel that was formed. So all the liquidity for dump down and for somebody who's like, okay, I could buy it on the top side of this and I was hoping that this would be held as support. You get a rejection up here at this level around 28,800. That's maximum liquidity pull. Maximum liquidity pull, because then everybody's like, oh, I'm safe. And the moment it starts dumping down, everybody's going to panic. Otherwise, we have to look to see if some kind of inverted head and shoulders is created here if it were to pop out. If it breaks down past 27,666, ironically, that would invalidate the pattern.
To make sure that banks are currently appropriately managing interest rate risk. And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy...
Wow, Marvin, thank you for the $19.99. I really appreciate that. And could you guys let me know in the comments what you think about a 20-minute update in the early afternoons each day going live. And if there's nobody there, there's nobody there, but it's going to be released to everybody anyhow. But then I can at least talk to everybody for 20 minutes and we can get, at the end of the update, I can talk as well. But that's something I've been thinking about incorporating, and I think I want to do it more and more.
And supervision can be handled with different tools. Thank you.
Sure. So the February 14th presentation.
100% agree, Sheena. Thanks, Darren. I think it's a good idea, too.
You didn't remember it very well. But now, of course, I've gone back and looked at it here.
I'm going to rewind his question because I've been pausing it for like a million times. Thank you, Crypto Scrooge. I appreciate that.
Carefully. I did remember it. And what it was a general
I'm
presentation.
not pausing it,
was
just
an
listen.
informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about that I recall anyway about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March to build liquidity. You asked about the separation principle. Like so many things, it's very useful, but ultimately it has its limits. I mean,
Oh, and real quick, everybody, and the idea with that is I wouldn't have my charts behind me. It would just be on me, like when you see the beginning of my videos, when I do my intro, and it would have this behind me so that you could see what's going on in the market, and we would just discuss what's going on in the market, and obviously I have the knowledge in my head, so I can tell you about the chart patterns and whatever, but it would be a more personable back and forth.
I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're...
Hey, somebody who had some balls to ask him a halfway decent question. I applaud whoever the hell that was. I wish he would have, I hope he follows up on it.
In the case that I'm not sure whether they mentioned, I think they did actually, they mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank and there are many other banks that are experiencing these things, and we're on the case.
Good, Victoria.
Hi, Chair Powell. I wanted to ask you, obviously with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a fact.
See, that's horseshit too. Of course he has an agenda. If he wasn't trying to consolidate the banks into a bigger one like JP Morgan, why the fuck did he loan him $50 million? Or whatever, $50 billion, whatever the fuck it was for the sale. The government loaned him the money. So this is all bullshit. See, this is what pisses me off. And this guy's going to run for senator in 2025 or 2024 or 2025 in Maryland. Like, give me a fucking break.
In the U.S. banking industry, really since interstate banking, and before that even, it goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of JP Morgan buying First Republic, the
Right,
FDIC
Daniel.
really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
The fact that they're getting larger in general.
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also,
I mean, listen to this fucking asshole. Did he just not lie to you and double talk his way back? He just said that it's not a good idea to have banks, the smaller banks, being eaten up by the bigger banks, and in the same fucking breath, on the back end of the sentence, he says, but it's an exception to the rule, and I think that this is a good thing. Like, what the fuck is he? I want to send you a gift to Michigan. No, I don't mind that. Just, you have to send me an email, though, at strutrugali@gmail.com. STRUTRUGA. What the fuck am I? Let me just type it in. How stupid am I? So, yeah, if anybody ever wants to send me anything, you just send me an email to strutrugali@gmail.com. Right there. I'll send you my address. And I've had multiple people send me something. And some people say, aren't you afraid of getting stuff sent in the mail? I get stuff sent in the mail every day. If somebody's going to do something like that and the mail can't catch it, well, you know what? I might as well. I'd be just as likely to walk out and get eaten up by a sinkhole. So, you know what? I've had many beautiful things sent to me. So, you know, obviously, if I don't know you, I probably won't send you my address. But if I've known you, I won't send you it if I don't know you. But if I've known you, I will. So, but yeah, for you XRP rippers, absolutely. I've known you forever. So, send it there. And yeah, Darren, like, mate, like, what the fuck? I'm like, let me just, I got my phone right here watching it on the live. You know, the messages just, I can see it coming across my tablet, but for whatever reason, it's like shit. Oh, no problem. You've earned that, XRP rippers. I swear you've been around since like 2021, maybe early 2022. And like, some people don't understand the value of water. And I know we got to hit play again, but some people just don't understand the value of water. This pH water, like when you get the proper pH, oh my God, to hydrate you, it makes you feel better. It makes your blood feel oxidized.
Would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the
Thanks, Aman. I appreciate that. Now let's go back to this guy's horse shit.
But ultimately, we have to follow the law in our agencies and the law as it goes to the least cost bid.
Anybody don't have a softball question? Anybody got a real question that has some balls to it?
Tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And, you know, when banks raise their credit.
My guy, since the very beginning, March of 2021. That's when I started, ironically, for anybody who doesn't know, and I've never missed a day. I've never missed a day since the day I started. I wonder who else can say that. I bet you nobody.
Standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that you know, interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate.
We're literally up at the first cup and handle resistance. So this is your first test right here. This is your first test right here. Oh, this is the USDT chart. Hold on. Let me bring up the other chart. I don't want to look at the USDT numbers. First test here is about, is that 457, 458? Somewhere in there. That's the first test. Second test to get out of here would be 46 cents. So these are your first two tests for XRP, 457 and 46 cents.
Is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it, and that's really all we can do. As I say, it does complicate. We have, you know, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Shire with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate.
I mean, answer the god. Like, listen, this guy is supposed to be the head. He's the chairman. And he can't answer a question whether or not this is, but what kind of data is going to tell you that? They're always, we need the data. We got to crunch numbers. There's no motherfucking data or numbers that is going to change your answer from now. But they never give the answer. I'm sorry, I can't give the answer because I don't have the data. It's not adequately equated. We don't sufficiently have the numbers crunched. I mean, they're asking, was this rate? I'm sorry, we don't have the numbers in front of us crunched properly. We haven't asked the other departments. I'm sorry, I can't collude with that department. I'm sorry, these are two separate departments. Like, are you fucking kidding me? Like, this is all branches of government. I'm sorry, this is above my pay grade. Sir, you are the head chairman. Nothing's above your pay grade, asshole. Like, I hate that. I don't know, it's not my job to know this bullshit. If it's not your jobs, whose is it? Should be mine.
On that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you. Okay,
I can say it with confidence. You're full of shit, and this is not a good thing. And it was restrictive. What's not restrictive about it? You're raising interest rates again, 25 basis points, because inflation's running out of control. And we know he is a puppet. He's a puppet. We're all puppet. I mean, every single person you see on the TV, every single person you see they're all. I can't say anything more because I have to be a good boy and I'll get expelled.
You will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting. And that's, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
A follow-up on credit. Could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th, in line with our usual time frame. And I would just say that the SLUICE is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from others.
So essentially, I didn't tell you a damn thing. Correct, everybody. You didn't say a damn thing. A nothing burger indeed. That was worse than, I mean, he sounds, you know who he sounds like? He sounds like when Biden tries to talk to the country. It's the same thing. I mean, that's embarrassing. And why does everybody who asks him questions sound so nervous? Like, who's it sounds like they've all been given a nice warm talking to and been told if you step out of line, your job's over. Like, listen how nervous everybody is. Everybody sounds out of breath, like they just ran a marathon.
Sources, you will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Hey, buddy.
Nick Timmer from the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year.
if you're going long, you better, like, if you're in a futures long, you better hope to God that we get a little steam here, because we're so close to falling off the cliff that I don't want anybody to get bent over. So hopefully you guys just get a little bit of good news here. But this, the way he's talking, I mean, we're if he says one wrong thing by the end of this, we could fall off a cliff. So just be aware. Either way, I mean, oh yeah, is this a nightmare? Good nightmare, but not a good nightmare. But if you're watching me and you're doing what I've told you to do for the last 2 years with metals and everything else, you're gonna get your day in the sun, and while everybody else is basically in the darkest times of their lives is gonna be the brightest days of ours, which is, it's bullshit. But you have to have foresight to be able to take advantage in these times.
So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so.
Bullshit. That's all I can think in my head every time he speaks. You're full of shit. Continue, sir.
So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control.
I mean, what are we balancing, really? What are we balancing? Are they balancing what? You just printed all this money to bail out fucking these banks, and then when they're small banks, you just give money to buy the bank by bailing JP Morgan out with a little bit of money. Hey, you know what? Wouldn't it be easy for us to buy these banks out if the government just gave us the money to do it? Imagine these smaller banks that can't pay their bills, and then the government says, oh, here you go, JP Morgan. Here's free money. You go buy this bank. Why not just give the bank that went out of business the money? Oh, that's right, because they need JP Morgan for the digital dollar, like I said before. Oh, the stable coin, the JPM coin possibly. But wouldn't it be easy to go right through JP Morgan when he manipulates gold and silver? All's linked together. Sean, what's going on, my main man from Maine? I think the market knows this rate hikes, and we'll probably see the crypto market move higher. Hey, well, see, everybody's anticipating a crypto move higher. That's why I'm saying be cautious. Everybody and their mother's calling for a crypto move up on YouTube. Generally, when they all call for a move up, because they were calling it yesterday and we hit 28,800. I mean, I don't know. Everything in front of me tells me it should dump. But, when there's market manipulation, whatever happens, happens. I'm just going to continue to say, if you're going long by futures, be very, very careful.
Against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned,
I don't know, because I don't know what a restrictive means anyhow. But the Dow's now down 150 points. I don't know what just happened here. It's a big reversal there. We'll see if that continues. We're going to put the Dow to the forefront on the back of it.
I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think
dude, this guy is so full of shit. Do you hear what he just said? I mean, seriously, I want to kick this guy in the nuts. I really do. We seen for a few months it was going down and then it came right back up. Why? Because it wasn't as bad as the way. Just because it's not as bad one month to the next, it's still awful when you still stay down by 4.25 or 4.5%. Just because it's not 6% one month and the next month is 4.5%, that's still awful. It's still 2.5 times over the 2% goal. So I don't know what the hell he's talking about. And then inflation's almost 3 times higher than that number anyhow. So there's nothing good about it. That's why the dollar's tanking and will eventually die. And why all these countries, which nobody ever wants to talk about, they get away from being on the US dollar and wanting to pay us in petrol with the dollar because we keep putting sanctions on them. That's the easiest way to get them out of the US dollar. Easiest way to make our money obsolete.
You're going to want to see that, that a few months of data will persuade you that you got this right, kind of thing. And, we have the luxury, we've raised 500 basis points. I think that policy is tight. I think real rates are probably, that you can calculate.
Yeah, but listen, he raised it 500 basis points, but he printed a shitload of money in 2023 to bail out the banks. So that 5%, now he's got to raise it 15%. He's full of shit. He printed so much money that he's raising rates against money. Do you know how ridiculous he is? He printed money to bail out the banks, and now he's charging himself another 0.25% interest rate. Imagine you taking out a loan from the bank today, and then tomorrow voluntarily raising it 0.25% for the same money. Or so that you can get a little bit more so that you can... Okay, you take out a loan for a car because you don't have the money. You take out a loan for the car. You get 4%, even though it's probably like 8 now. Then you get the car and you're like, oh shit, I don't have enough money to make the car payments. Oh, no problem, Tom. Here's another $30,000 at 0.25% higher on top of your loan already. We'll just add it to the top. I mean, do you know how stupid this sounds? It's the stupidest thing I've ever heard. You're borrowing money and then you raise interest rates on the money you had to print. It's the dumbest thing I've ever heard. It's single-handedly going to collapse the rest of the banking sector. But he's saying it's not on purpose. That's horseshit. This is all by design. It's to single-handedly collapse the dollar, and he's doing a damn fine job at it.
Many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think
there's no QT. There's no quantitative tightening. In quantitative tightening, you don't print all this money to bail out the banks. How much money did they print? Billions. And he's saying we're in quantitative tightening. The budget got bigger. When have you ever heard of something tightening, but then it got bigger? That'd be like me saying I've got a $500 a month budget and spending $600 and saying I tightened my budget. Are you out of your fucking mind, this guy? Like, honestly, it's a joke.
I think you feel like, we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
I'd be okay with a prolonged 3%.
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, we
never see it again.
That's not a question that's in front of us, and it would depend on.
We will never see 2% again. We will never, ever, ever, ever see 2% again. He can say that all he wants. You'll never see it again.
So many other things, but ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Hi, Chair Powell. Matthew Bosa with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their...
No, man. The case will not settle, Fadi. Like I've said, since 2021, this case is likely going to go until at least the last end of 2023. Or it could possibly run until 2025 when they're ready for everything to get in place. But there's nothing that can happen until like September of this year, because you have to wait 6 months for the summary judgment to be ruled on, because there has to be a 6-month waiting period for all the mumbo jumbo and bullshit. So that's why we get all these nonsensical influencers on YouTube or social media crying foul, because they know everybody just listens to it month after month, day after day. Like if you're listening to anybody who's told you it 700,000 times over the last 2 years that a settlement is coming, I would highly advise you to watch somebody who hasn't cried wolf. It's that simple. And that goes in general for all of crypto. Anybody who has told you that we're in a bear market rally, that we are in short coverings, and they're telling you we're in a all-out bull market and the bottom's in, never watch them again, because you've lost all your money if you have.
Line forecast as well, given the strong first quarter GDP tracking estimates. And so I'm
The sad thing is you don't even know you've lost all your money yet. That's the sad part.
just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand really in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is, I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal, and then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the employment compensation index, average hourly earnings, the Atlanta wage tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver. I don't think that's really right.
Great. Christopher Gabriel at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So to get
possible reversal there on the dollar, we'll see what happens there. If that can reverse at all. But it's going to have to real quickly here. Still on a short-term bullish trajectory, just in the immediate short term. So we'll see what happens, if it can even get out of here. But it's not looking great.
I think as goods pipelines have gotten, back to normal so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins going down as a result of a return of full competition where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about...
Once he gets done talking, I'm going to have to end this because my son's getting ready for his afternoon nap, my 3-year-old. But I want to finish this with you guys real quick.
What your policy reaction function is, your policy framework is going forward. When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay. So what are we looking at? I mean.
Oh, no problem, True. I appreciate you being in the audience, my brother. Appreciate it greatly.
We look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both. And it'll be the obvious things. It'll be readings on inflation, it'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards? And is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. it's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet. And now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of, of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
So we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, then markets have been from time to time pricing in quite rapid reductions in inflation. We factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that?
I mean, true, it's possible it goes up. We need to pick up some momentum here in the short term, because a few more rejections like this, it's going to end up forcing its way back down to this 44-cent area. I think it needs, honestly, what I think it's trying to do, if it doesn't break up to that 475 in the short term, I think it's trying to come back to this formation breakout point and give it a solid retest. Whether it's going to break back through the 424 or not, that remains to be seen. But I think it's trying to give a solid retest back in that area. I really do. Because it was in that formation for so long. And this was finally, that's where I put the pivot point. Like, if it broke up above there, it was going. And that's exactly what happened. And now, my question is we've never really, we came up, rode it a little bit, went up, but we've never really retested this. And it really looks like it could be a proper area right there at 424 to retest. If this is a right arm on this head and shoulders pattern, or this M-topping reversal, or whatever you want to call it, the 424 would be a likely retest in here, and that's what worries me. I want that bottom retest so bad, because if it retests there and holds, oh my God, it would be so fucking beautiful. That's what you want. If we want a major breakout, we need to hold that retest. That's how simple it is. But, there's many ways to look at the patterns as well. That's just my shorter term outlook. But in the longer term, we're within two separate patterns. Right now, what you're talking about, True, is possibly playing back up and retesting and maybe getting a little overzealous and running back into like this 487 area or somewhere on this to verify the breakdown. So we'll see, though, because even there, it shows the 40-cent mark on the bottom side of here. So it's all fucked. It's all going to depend on if we can get a little bit of attention here. We need to do it quickly, though.
Put on the table in the future. Thanks.
So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewell-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country?
Sheena, we are dead center in the liquidity. That's the problem. You've got over the top liquidity. You've got underneath liquidity. Like it would be nice for it to go down and get that liquidity lower so we go up higher and get that retest liquidity around the, especially for Bitcoin. Bitcoin would actually benefit from going down to 27,550, then shooting back to 28,800 because you can get everybody trapped in between. And then if you get enough short coverings, it could push it up to 34K, 35K area.
The markets and borrowing.
Yeah, I would just say it's I don't really think we shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say no one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you said in your briefs would be necessary?
So I
pay attention. The Dow's starting to fall in some hard times here. It's down 261 points here all of a sudden. We'll see if that continues.
I didn't take part in creating the report or doing the work, but I have read it, of course.
Oh, what a surprise. The chairman took no part in the report. I mean, what the fuck? Oh, yeah.
And I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, but a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that is
I don't know. I just have a strange feeling if the DXY holds that 101.16, it's going to end up moving a little higher. But at the same time, that looks atrocious as well. But that's a big support it's at right now. So we'll see. We'll see what happens here because, oh man, the market's literally teetering right now. And just remember, May's typically bearish for crypto. Despite what everybody says, May's typically a bearish month.
May just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
It sure could, True.
Thank you.
It sure could. Just a simple sneeze.
Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
Well, I don't know how to answer that.
I guess I would say it this way.
Let me read my prepared notes, sir.
There were three large banks really from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved.
Oh, really?
Depositors have been protected. I think that the resolution and sale of
that's a line of horseshit.
kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay?
How are we moving? How does even, we just had First Republic that just went to shit last weekend, or the weekend before last, and JP Morgan just bought them by the government's loan money. How is this resolved? The next one's about to fall, SoFi. If you don't know what SoFi is, take a look at it. The stock dropped like 20% in minutes. I talked about it yesterday, and I put a tweet out saying I think SoFi is the next to go. If you don't know what it is, pay attention. That'll probably become JP Morgan's left nut in a week.
I also think we are very focused on what's happening with credit availability, particularly, you know, with what you saw in the beige book, and you will see in the SLUICE is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
So basically, I don't know what the fuck I'm talking about. You should have just said, I have no idea, sir. I don't know.
Thank you, Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought...
Yes, I couldn't resist. No, Jan Love, there is none at all, unfortunately. And this guy is such a tool. Like, I don't even know if he knows what macro and micro is at this point. I don't. I think he very well could be a drone. He could be the early stages of the AI takeover.
The report was unflinching and appropriately so. I welcome it, and I agree with
right there. And like,
I do feel that I'm personally accountable to do what I can to foster measures.
Nah, that's nothing. It's okay.
Address the problems. So on the Vice Chair for supervision, you know, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall deploy policy recommendations, develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such.
Exactly, you oversee. He's trying to prove why it's not his responsibility, but it says within what he's writing to oversee. What does oversee mean? It means you're overseeing. You're in charge of what's going on. You make the decision. You're overseeing. It doesn't matter what some other douchebag says. You are overseeing the process. What the hell is going on? But he's overseeing the process. Like, I don't understand. Oh my God, this guy's so stupid.
So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person.
Yeah, I don't know why it made me accept your fuck your humble pie, Jerome, Christian Kennedy, but I said yes, that can be posted. Of course it can. We don't hide from dirty language here.
To have political accountability for developing that agenda. So the way it works, the way it has worked
right, true.
For me is I've had a good working relationship. I give my counsel, my input privately, and that's
That's not his job. His job isn't to have a good relationship with these people. It's not. His job is to give the input and make the decision. You're going to give your input in private? Are you? Sounds like to me that he's getting paid off in private. He's getting the wada in private. You know, I don't know what his I'm not even going to go into it. But this guy, in one way or another, is getting off in more ways than one during this council or whatever the fuck they're talking about. Because he is so full of shit. This guy has no idea what he's talking about anymore. Nobody does. If you listen to them, everybody within the FCC or the SEC and the government, they've told so many lies, they don't know what to say anymore. There's nothing else to say. There's nothing else to say.
That, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And,
oh, mark this down too, True, and anybody else who's interested in the banking stuff. KBW Bank. KBW Bank. If that's true, KBW Bank has its lowest level, what is it? KBW Bank Index at lowest level since 2020. That's not a good sign. But guys, don't worry. Jerome Powell just said the banking, it's at the end of this nightmare. No, folks. This is just the beginning. This is just the beginning of all the mom and pop, all of the smaller banks, all of your state-run banks, all of your credit unions, and things like that. This is just the start of them being flushed down the toilet and becoming an appendage of JP Morgan. Nothing more, nothing less. It's almost like they harvested the organs of these banks and rejuvenated JP Morgan or Chase Bank. Isn't that a bitch?
But it isn't. I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the.
I never wanted to go cut my grass more. Just shut the fuck up so I can end this.
Really, in supervision, has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on what you control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again.
Oh, and control the controller. That might be a old quote from what a wholesome man, Henry Kissinger, when he said, if you control the food supply, you control the people. It's essentially what he's referring to. So take that with a grain of salt.
What those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're.
That's yes, sir, Darren. Never let a good crisis go to waste. But this is the insulting part. They're taking advantage of the people that don't understand. That's not what they're there to look out for the people that don't get it. See, some of us get it. Some of us are awake. And the ones who get it are preparing properly. The problem is 9 people out of 10 that I come across, and I've got 16,000, almost 200 subscribers now to this station. 9 out of 10 of you I come across doesn't want to hear it, which means about 15,500 out of 16,200 people are screwed. That means 700 of us out of 16,200 are going to be okay with the next phase. It's not okay. It's not enough people. That means all my neighbors, when the foreclosure signs are going up on their houses, I'm going to be at the best financial advantage that I've been in my entire life when I don't even want it. That's a time when you're going to have all of that, and you're going to see your peers are suffering. That's why I started this station in 2021. I said it then and I'll say it now. This for historical record, anybody who's following along is going to be well off. I've been doing this since 2017 for a reason. It hit me like a ton of bricks in the nuts. Like getting the wind knocked out of you. When I realized what was actually going on with the financial sector. And it got me in order. Got me in gear. Got me to a point where I could take out a whole bunch of credit and use it for myself. Even though I don't stack credit. I built everything up. Did the metals thing. Do what I need to do to where I don't need to go work a 9 to 5. I haven't worked a 9 to 5 in 3 years. Which means I'm at home 24/7. Which is actually a good thing since Julie's accident. And her 5 surgeries. And my son at 6 months old breaking his femur in the accident. Yada, yada, yada. The point is that I started preparing this for a reason. And the ones who aren't preparing, we're running out of time. Legit running out of time. We're legit running out of time. And I can't preface it anymore. We're running out of time. And then people tell me, why do you do what you do? Because I don't want to be the only one left. It's that fucking simple.
Close or maybe even there. But that, again, that's going to be an ongoing assessment. And we're going to be looking at those factors that we listed and to determine whether there's more to do.
I'm curious to how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something.
No, some of these comments are fantastic. I don't know who's worse either. I think he's worse. I think Jerome Powell's worse because he sets all this in motion for Gensler. So, they all work together, but it just kind of allows them to do whatever they want. But yeah, Mark Kelly, you have to be as self-sufficient as possible. And that's why I've been re-educating myself on growing the last 3 years. And this year I'm already so far ahead. I've got so many things that I'm growing. I actually bought a thing, so I'm building a little section off for a garden in the backyard. Like a raised garden type thing, but not like with wood or anything. It's actually going to look really cool. And I've already got 200 pounds of dirt that I bought that is sitting there, but I've got to buy a lot more. But I'm trying to turn this whole thing into a big self-sufficient thing. Yes, I want to show what Mark is saying. I don't care that he is... Wait a minute, why would it make me show that message? All he said was, big thanks, Tom, for all your work. I always try to wake up my friends, but they don't get it. They think I dream. I talk too much shit. Oh, because of the last word, it was trying to hold your comment. And yeah, True said, I threw the whole damn salt shaker over my shoulder and broke my neighbor's living room window. She came out yelling, what the fuck? And I said, facts are be stupid. I should have just took it with a grain of salt, like you said, Tom. Yes, you should have. The grain would have been very hard to break that window. But yeah, Darren, it's absolutely closing. Ooh, Hydro Tower Garden. I will definitely look into that, Sheena. Make them with PVC and pump. Interesting. I used to do a big garden back in the day when cannabis first became legal for medical purposes in 2009, 2010. Had a nice little grow room back then. Oh, I swear we think the same brain. For sure. For sure. There's only a few people that I've come across in my YouTube days that share the same brain with me, and there's a few of them in there right now in this chat. But True, you are definitely one of them. Definitely one of them. And the other ones, I already know who they are. All right, let's listen to this guy. We got to end this. So I'm going to go cut my grass in the rain. That's how brain dead he's made me.
That's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that we're gonna revisit. It's pretty clear we need, to me anyway, it's clear that we need to strengthen both supervision and regulation.
Just as I suspected, there's nothing inside of the brain of old Jerome. I was suspecting it. This is where we keep his brain. That's the resting place of his brain. There's nothing there.
For banks of this size, and I'm thinking that we're on track to do that as well.
Being more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy.
Yeah, that's.
Olga, welcome in. It's been a long time since I've seen you. Welcome in. It's awesome to see you're still here. That is incredible. Like literally one of the earliest supporters of mine. Wow. I'm happy to see you too. It's actually, you made my day, to be honest with you. Well, I have not seen your name in so long, like in these lives. Wow, what an honor. Thank you so much. What a live this has been. You know, I mean, it's about to end. If Jerome would ever actually end this without just now, I'm sure it's already over, but I've been talking through it, so, you know, it's the way we bond. It's the way we bond. It's the way we bond.
What Vice Chair Barr's role really is, and he'll take the lead on that.
Thank you.
Thank you.
Oh, I bet you it's been a trying time for you with what's going on, especially working with the Ukrainian people in Holland. That's got to be, I don't know if I'd call it a rewarding experience, but it's definitely, it's something that someone's got to do, especially with what's going on, because we got a lot of innocent people that are dealing with a very interesting time abroad. Hallelujah, he's done. All right. All right. Truly a lot of amazing people that get caught in what's going on. And it's not a very good thing, and it is truly eye-opening. It is. All right, so I got to go. My son needs to go to bed. He needs to take a nap. How long were we on? An hour and 36 minutes. Wow. I appreciate everybody who's here. 46 people, so that's incredible. You know, I don't advertise this to, like, the abroad. I just put it on my little thing, so I prefer to keep it smaller, but somehow the channel grew to over 16,000, so, you know, I'm eternally grateful, and we'll see what happens from here on out. And everybody have a beautiful day. Thank you, Olga, you too. Darren, Jan, thank you so much. I appreciate everybody who's here right now. True. We got, just real quick, the ones that I know that are here right now towards the end. Christian, thank you so much. Darren, Jan, Mark Kelly, True, Olga, XRP Rippers, Crypto Scrooge, Sheena, Jan, who else? Mike Schultz, thank you. No problem, my friend. Daniel, Urbane. I think that's Mohad Fadi, and no, the case will not settle. Mr. Crothers, the Focus, I appreciate you guys greatly. XRP Rippers, Mark Kelly, cheers, everybody. Have a good day. I'll take my bow, and I appreciate each and every one of you and everybody who sent a donation. Stay blessed, everybody, and we'll talk. I'm going to start doing these lives early afternoon, and they're only going to be 15 to 20 minutes. But if you care to watch in the early afternoons, I'm going to do a normal update in the morning, normal update in the night, like I always do. But during the early afternoon, I'm going to start to do a 15 to 20 minute live update. And you may or may not see my screen. It might just be how I do my intros from now on, to where I can talk to you personally. I'll do an overall market recap. We'll go over what's going on in the U.S. 10-year. We'll talk about inflation. We'll talk about the dollar. And we'll talk about what's going on in world economic events. But it'll be like an all-in-one, what's going on, midday market wrap-up. And then we'll do it in the morning, my normal updates with the charts and me, where you can see me. Early afternoon, no charts or anything, but we'll talk. We'll have a back and forth for 15, 20 minutes. It'll likely start catching on after a while. And then in the evening, I'll do my same kind of update. But I'm looking forward to starting this tomorrow. So we'll see what happens. And I look forward to seeing 5 or 10 of you in there tomorrow and growing from there. I'm eternally grateful for each and every one of you, and have a blessed day. I can't even thank you enough. Oh, Tom, thank you for the $5 right at the end. Wow, you caught me off guard. Thank you so much. Hey, I appreciate everybody who said you'll see me there. That means a lot. It really does. I will see you all there as well. And Michael Vaj, I did see you're here as well. Have a good one, my brother. Have a good one. Peace out, everybody. I can't thank you enough.